Well, now it's time for us to look at a few exercises from Chapter 2, and these relate directly back to our PowerPoint. You could also go back and look through the chapter and read Chapter 2, probably very helpful there. In this format, we're going to be looking at preparing the journal entries. There's not too much of this done as T accounts, but the T accounts are sometimes helpful for students. I think you should go back and you should look at it and see that how the T accounts and the ledger and journal entries are all connected, and how that when we do a journal entry, it's very similar to what we are doing when we do it in a T account. And understanding those relationships will probably help you. This particular example here is going to be a builder that's starting operations July 1st, and this is their first month of business, and we're looking at some transactions that are happening. You can go back to it and think about it from the first part of our PowerPoint 2, and part 1 of PowerPoint 2 we said first thing you need to do is analyze. Talk about what's coming in, talk about what's going out, then start talking about the accounts that are involved. After you talk about the accounts that are involved, you need to go back and you need to start thinking about the debit and credit rules. Maybe in your mind you need to start thinking about the accounting equation, and you need to recognize the normal balances. So the normal balances and the increased balances are always on the same side. For assets, it's a debit, and for liabilities and stockholders' equity, the increase and normal balance will be a credit. In the first one, we are receiving $70,000 cash that is invested by owners, and we're issuing stock. It's very similar to what we had in the PowerPoint. So we know that the accounts that are going to be affected here will be cash and will be common stock. And we know that cash will go up, and cash is going to be in an asset, which is going to be on that left side. So when we analyze the transaction, we know our left side is going to go up by $70,000, and our right side needs to go up by $70,000. Question is, how does that right side go up? What's the accounts affected? And here they're issuing stock, so it's an equity account. So in doing our journal entry moving ahead, you would be putting in cash going up, which is a debit, and then the right hand side is going to be the common stock, which is a credit for that same amount, because when we do the journal entry, it has to be equal. Our debits and credits must be equal. Now we bought a field and we paid $60,000 cash for it. In this particular thing, you can see that we have a field, and a field would be an asset. It's real estate. We are paying $60,000 for it, and so we are giving up another asset. So it's what I would call an asset swap. If we went back and looked at the accounting equation, we would see that two assets are one is going up and one is going down, and the right side of the accounting equation is not affected at all. It is totally within our assets. So the asset that goes up is the land, which is debited. The asset which goes down is the cash account, which is credited. In this transaction, they're giving us some what I call bogus information, or information that's not relevant to when we're talking about the transaction. When we're talking about a transaction, we're talking about what is given up and what is received. In this particular transaction, it doesn't matter that this construction site is estimated to be worth $65,000. That's not relevant. It doesn't matter because it's not the transaction. The transaction was $60,000, which was the cash. So returning to the PowerPoint slides that we just finished, which was PowerPoint 2, Part 2, we said that when we value things, we're either looking at cash or we're looking at liabilities usually. The first transaction, transaction A, the value of this transaction, the total debits, total credits was $70,000. That was the cash which we got in from the common stock. The second one, the amount or the transaction is $60,000, which is the cash that we are giving up to get the land. Not the value of the land, which is $65,000, but we actually give up to get it. And now on C, a lumber supplier delivered supplies for us for future use. They would have normally sold for $10,000, but the supplier gave us a 10% discount. Again, when you work through this transaction, you need to start thinking about this transaction and what the amount would be for. And when we work through this, you're going to see that the amount which we are going to be requiring to pay in the future. Now, we have not received the bill from them, but we know that as soon as we ordered these supplies and the supplies were delivered, here it says they were delivered, we're not going to pay $10,000. How much are we going to pay? We're going to pay $9,000, and $9,000 again is a liability account. The calculation is given down there. Borrowed $25,000 from a bank with a plan to use the funds to build a small workshop, and the loan must be repaid in 2 years. When we borrow the $25,000 from the bank, this transaction means we're going to have some cash coming in, which is on the left side. The right side needs to be accounted for either as a liability or as an equity, and of course it's the liability. So the cash is going to go up, and we are also going to have an increase in our liabilities of $25,000. Saying that the loan will be repaid in 2 years tells us that it's not current though. So when we do our balance sheet, we're just going to keep track of this, and we're going to know, well, that loan must be repaid in 2 years, not within 1, so it can't be current. One of the owners sold $10,000 worth of his common stock to someone else for $11,000. Now, the key to this thing is, again, to go back to the transaction. Do we get any cash out of it? No cash comes into us from this transaction. It is a transaction between the owner and a new owner, and this transaction has no effect on our company. Therefore, we don't have to go into thinking about the T accounts. We don't have to think about the accounting equation, debits, credits, any of it, even the amounts, because we are to the point now where we're saying it's not a transaction to us. We don't have to be concerned. The next exercise is we have a company that's starting in the beginning of August, and they're going to sell new and used books online. And the same sort of thing is following as what we've had of our instructions in the past exercise. We're going to look through at this. We're going to try to figure out what is going to happen with these accounts. So here, purchased equipment for $4,000 cash. Well, this is an asset swap. We're giving up cash and we're getting equipment, and the amount, again, is determined by either the cash or the liability. There's no liability in this case. It's paid for with cash. It's expected to be used for 10 or more years, which tells us that this equipment that we are purchasing is not a current asset. I'll tell you right now, though, that cash would be classified as a current asset because we expect it to go away within the next year. Joel's business bought $7,000 worth of books from a publisher and will pay the publisher within 45 to 60 days. This is what we call inventory because it's something that's going to be resold. The reason why we know it's going to be resold is because when we go up here, we find that this company, Joel Henry's company, Book Mart, sells new and used books. And they're buying books. If they buy books and that's what they sell, this is what we call inventory. This is going to be paid to the publisher within 45 to 60 days. So you pay it within 45 to 60 days. That's clearly within the year. That is an accounts payable, which is a current liability. If you need to think about it, you can go back and you can work your way through these as we did initially, where we said assets equal liabilities plus equity. Assets increase on the debit, liabilities increase on credit, as does stockholders' equity. Therefore, this is increasing an asset, increasing a liability. So the asset is debited, the liability is credited. We're going to continue with some more transactions here. And with this, we have somebody lending our company $4,000. Now, if it said that Joel's friend Sam lent $4,000 to him so that he could, I don't know, take a cruise, go on vacation, this is not a business. This is not a business loan. However, this involves a note, and it says that the company is promising to pay it back. So it doesn't matter if they're good friends or not. It is a transaction that involves the company, and therefore it is a liability which is going to be recorded by the company. What is the amount of liability? It's going to be the amount of the cash that's coming in or the liability incurred. Both of those are applicable in this one. So the cash coming in is $4,000. The liability is also $4,000. Now, on D, we are paying cash for books which were already purchased on account, and therefore we are not going to be debiting inventory with this one. Instead, we are going to be paying down what we owed on this purchase which was made earlier. Now this should be a credit. I apologize for it being so far to the left. Should be over here. So accounts payable, our liability, is debited. It goes down. Our cash account also goes down. It should be showing up here as a credit. So it should be over here as a credit. Bookmark repaid the loan which was done in C. So up here when we had our friend loaning the business the $4,000, we're going to pay it off, which means that when we incurred this over here as a liability, this liability needs to go away. It gets created as a credit and its normal balance is a credit. To make it go away, we are going to have to debit it. So a debit reduces the balance and takes it away. It now should be what? It should be a zero balance in that account. Again, this cash should be over here to the right as a credit. Sweet Shop is a chain of candy stores that has been in operation for the past 10 years. If it's not a transaction, again, write no transaction. Ordered and received 12,000 worth of cotton candy machines. And we're going to pay for these machines in 45 days. So this is going to be a liability that's going to go away in 45 days, and we did receive them in. So since we have received something in, it is a valid transaction, it is equipment, and we are going to be paying for it with an accounts payable. We're going to turn around and we're going to pay off that accounts payable with cash. Now as this one is right, we do have cash going down as a credit, and it's showing up in the right column here. This is a credit. We're reducing our cash. We are also reducing our accounts payable. Now, we got $400 coming in from customers. We haven't talked very much about accounts receivable, but if we have a sale transaction and the customer does not pay us with cash, we call that an account receivable, which is an asset. Just as payables are liabilities, receivables are assets. And what is happening here is those customers who bought candy from us are going to make good. They are going to pay. They're going to pay us with cash, which is going to reduce the receivables that we owe. We are owed. We can't go out there and we cannot collect again this $400 from these customers. The customers have already paid down that $400, so this is the end of that. To help raise funds for store upgrades, they issued 1,000 shares of stock for $15 each to existing stockholders. Okay, now this is a bit tricky because you're going to want to put in here, and they say to raise funds, that means, well, we must have got 20,000 in. No, what we got in was the $15 per share for the 1,000 shares, or $15,000. That's what we got in. And when we do it, of course, the opposite side of it is going to be here, the common stock account. On E, you're buying equipment and you're partially paying for it with cash. So your equipment is going up and your cash is going down. So your left side of the accounting transaction is going to be affected here. The net effect is going to be $50,000, which means the right side, which is there's either going to be liabilities or stockholders' equity, must be $50,000. So working through it that way, you can see that this is the right way to handle this transaction. A number of different ways to get at the solutions to these problems. The $10,000 is cash going down. You reduce an asset by crediting it. The $60,000 is gaining the equipment. You increase an asset by debiting it. Now, to make everything balance, we also notice that we have a note, which is $50,000 happening there. Now, Katie Williams is the manager of Blue Light Arcade, providing entertainment. Alright? Received $50 cash on account for a birthday party held 2 months ago. Okay, now what's happening here is you're getting in cash. The birthday party has happened in the past and it was on account. So this is accounts receivable because the birthday party, the transaction that created the revenue, happened 2 months ago. So someone here is paying us what they owe us. Therefore, what they owe us, which we have receivable coming in, is going to go down by 50. On B, we hire a new employee at a monthly salary of $3,000 and they start work next week. This one, you have to go back again and say, what's a transaction? What are we giving up? And what did we give up with this one? I don't think we've given up anything because the employee hasn't worked. We haven't paid the employee, so there's no transaction. On C, paid $2,000 for a tabletop hockey game purchased last month on account. Alright, we are paying, so that means cash is going to go down and cash will have to be credited. The question is, what is going down? What is the debit going to be? And the debit is going to be to a liability. And the reason why it's accounts payable is because of this. On account business. If you recall from our PowerPoints, we said when it says on account, it's accounts payable. So we are paying down a liability with this transaction. Repaid a $5,000 bank loan that was outstanding for 6 months. Now, payments are credits to cash, so I can say, well, we're going to credit cash. And what are we doing with it? We're getting rid of a loan. So going back to the accounting transaction, the left side says cash is going to go down, assets are going to go down. The right side says something else must go down, and it is indeed it isn't a loan, it is a liability and not an equity. So we can work through this and we can see that cash is credited and notes payable, and it says 6 months would be short term. So this would be in the current section, and that's why it's classified that way. Now we're buying an air hockey table, and the value again of something which you purchase is the cash and the liability. Cash or liability. In this case it's cash and liability. The cash we're giving up is $1,000 and the short-term note is $1,200. So the equipment coming in is $2,200. The leftmost side, the asset side of this, the net effect on assets is going to be $1,200. Do you see that? $2,200 minus $1,000. The right side in the accounting equation is going to be liabilities and equity. The liabilities side is going to be $1,200. So the liabilities is going to go up by the same amount as the assets going up. We continue to be in balance. And this is the way that is recorded. This is going back to what I was just doing, using the asset effects here, doing it in the accounting equation. Received $10,000 cash from owners and issued stock. Okay, got that one in there. Borrowed $7,000 cash from a bank and signed a note due later this year. Well, if we borrow money, that means we're going to get more money in, and we can spend that money because we borrowed it. So we got the $7,000, and the right-hand side is a note. Since it's due later this year, we are saying it's due within the 12 months and is classified as short-term. On C, bought and received $800 of equipment on account. Oh, well, this looks like one of those asset swaps, doesn't it? Or is it? It says on account. What is on account again? On account is an accounts payable. And so no, this is not an asset swap because we did not pay for it with cash. We do get this asset in, which is equipment, and we are going to incur a liability, which is an account payable. Account payable again because on account. Purchase land for $12,000, and we're going to pay cash for part of it and a long-term note for the rest. This is a transaction here where we know our assets are going to be netted out. So it's not going to be $12,000 in assets that's going to go up. It's going to be a net effect on this one. And the right-hand side has to reflect also that net effect. So 12,000 land, cash going down by 1,000, note payable 11,000. And E, purchased equipment, paying $1,000 in cash, very similar to the other one. The difference between this transaction and this transaction, you can see it best probably down here, is that in this transaction, these two are netted. In this transaction, these two are netted. But this one is long-term and this one is not long-term because it's an accounts payable. More journal entries. Here we are receiving cash and issuing stock. Here we are receiving cash and coming up with a note. Here we are buying equipment on account. And so I think these are the same journal entries, except in these we are writing them down as journal entries and we're not doing them in the account analysis. And always check, as it says here, that your debits and credits are equal to make sure everything works. Okay, that's all for now. Thank you. You now can go ahead and work on your Connect exercises. This would be Chapter 2, Connect, which should be worked on and completed by noon the next day.